In the turbulent economic landscape of the past 3 years, a series of jaw-dropping developments have left both experts and the public stunned. One of the most glaring phenomena has been the surge in inflation, catapulting the cost of goods across America at an unprecedented pace in the aftermath of the events of 2020. Fast forward to the unexpected turn of events in 2023, and the economic narrative has undergone a massive shift practically overnight. Contrary to prevailing expectations of a continuous upward spiral in prices, influential figures such as Doug McMillon, the visionary CEO of Walmart, are now sounding the alarm about a potential descent into an era of deflation. This prospect, a rare occurrence not witnessed in the country for decades, adds a new layer of intrigue to the economic rollercoaster that has kept the nation on the edge of its collective seat. The uncertainties and surprises of the economic landscape continue to keep everyone guessing about what the future holds as the pendulum swings from inflationary anxiety to the potential winds of deflation. Deflation might seem like a good thing, and in some ways it is. I mean, who wouldn't like to pay less for stuff, right? But when you look back at times when prices were dropping, especially in the United States, it usually brought some serious economic headaches. Here's the deal, deflation is like a nightmare for the government because it triggers what economists call a deflationary doom loop, and as you're about to see, deflation is pretty much a disaster for regular folks too. When prices are going down, the government sees big problems on the horizon. Here's why. People catch wind that prices are dropping, so they hold off on buying things, thinking they'll get an even better deal later. Sellers start to freak out and lower their prices even more to compete with one another. This sets off a chain reaction where everyone realizes prices are in freefall, so they hold off on buying even longer, expecting things to get even cheaper. It's like a never-ending loop. Now, this loop creates serious issues for companies. Even if they lower their prices, they can't make a profit and they start losing money. That, my friend, leads to all sorts of problems, eventually resulting in job losses and a bunch of other consequences. This was the case in the Great Depression years when unemployment rose to double digits, and in the Great Recession more recently when unemployment hit over 10%. So yes, while prices may go lower on everything, it also means demand and consumption go lower, which results in serious issues within the job market. And now economists are starting to worry. You can hear why this is the case by listening to Charlie Mungers speak about this exact problem from this clip. It's a bit long-winded, but I think it's worth a listen considering that this is where we're headed if other sectors of the economy continue to head down this path. Now, before I show you the clip, I would greatly appreciate it if you just took 2 seconds to hit that like and subscribe button if you're enjoying the video thus far. Now back to the clip.
Mr. Munger, this morning while discussing index funds, used the example of Japan as a real example of poor performance of a major index over a long period. Indeed, the S&P 500 index declined over 60% in real terms from the early 60s through the mid-70s. Could you discuss the mental models you use to consider the impact of inflation or deflation on your investment decisions and the likelihood of either occurring over the next decade?
Well, that's partly easy and partly tough. If interest rates are going to go way up, you can obviously have a lot of deflation of stock prices. And a lot of that happened in the American period you're talking about. What's interesting about Japan is that I don't think anybody thought that a major modern Keynesian democracy pervaded by a good culture in terms of engineering, product quality, product innovation, and so forth, could have a period where you would have negative 13 years without major depression either. I think that it would occur while interest rates were going down, not up. I think that was so novel that the models of the past totally failed to predict it. But I think these anomalies are always very interesting, and I think it's crazy for Americans to assume that what's happening in Argentina and what has happened in Japan are totally inconceivable forever in America. They are not totally inconceivable.
As you can tell, Munger emphasizes the fact that the United States is not immune from things that have happened in places like Argentina and Japan. In Japan specifically, there was a time where the country experienced something called the Lost Decade. From 1991 to 2001, Japan experienced extremely slow GDP growth, frequently tipping into contraction. Unemployment rose and consumer spending declined. The stock index plunged from an all-time high of around 39,000 in 1989 to under 8,000 by 2003, a nearly 80% crash. Companies saw revenues and profits dry up during this lost decade of zero growth. More strikingly, the land and housing bubble that initially collapsed led to a 70% plummet in Japanese property values throughout the 90s. The price of commercial and residential real estate absolutely imploded after the bubble burst. The crises spread from stocks into the broader economy. In addition to stagnant growth, Japan wrestled with persistent deflation in prices and wages in the decades since. Extreme monetary policies such as 0% interest rates and quantitative easing have failed to reignite inflation. An aging, declining population has further hampered this problem. Munger cites Japan's economic history as an important reminder that severe financial crises and extended recessions can unexpectedly arise even in highly developed countries. When asset bubbles burst or credit markets freeze up, the fallout can be severe and long-lasting, more than a lost decade. No country is completely immune from such an occurrence, including the United States. Now, everyone is asking, is this a sign of a deflationary loop? Let's break it down with some examples. Take lumber, for instance. Since its peak in April of 2021, the cost has dropped by about 72%, aligning with the 2019 average. Used cars are following a similar trend, with costs down 19% from their peak in 2021. Even crude oil, a major player in the global market, has taken a hit, falling by 37% since its peak in June of 2022. New homes have seen a gradual decline of 17% since their high point in October of 22. In a nutshell, there's solid evidence pointing to deflation making its way through the economy. As these changes unfold, the big question on everyone's mind is, could the housing market be the next domino to fall? Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed the video, and make sure you leave a comment below letting me know what you're seeing in your local neighborhood.